Welcome to today's update video called Breaking Down Barrier Income. Breaking Down Barrier Income is a monthly series featuring Simplify's Barrier Income ETF. The ticker symbol is SBAR. SBAR launched mid-April of 2025, just over 8 months ago. We believe SBAR is redefining the structural product landscape by transforming the structural note experience into an innovative ETF. My name is Jeff Schwarty, Chief Equity Strategist at Simplify. Today I'm joined by Emilio Freire, Lead Portfolio Manager for SBAR. Emilio, can you provide the audience with a little bit of background about yourself?
Of course, hi everyone. So I work as a portfolio manager at Simplify, where I co-manage our convexity suite, essentially covering equity plus downside and upside convexity ETFs, as well as what we call our income suite, which is built on beta exposure with an options-based income overlay. And then, of course, more recently, I've also taken on responsibility for managing our barrier income products, which is the focus of today's conversation. I've been with the company since its inception over 5 years ago, originally joining as a quantitative research analyst, working closely with our CIO and the different portfolio managers on the design and implementation of our equity derivative strategies. At the moment, my current research centers on building systematic frameworks to capture volatility risk premia, especially in equities, and also designing long volatility overlays for tail risk hedging.
Yeah, we're very blessed to have you, Emilio, working with the Barrier Income series. We have SBAR, XV, and XXV, which launched recently. So thank you for that background, and we are very fortunate to have you on board at Simplify. So in today's video, we'll be reviewing performance. We'll talk about the realized distribution yields, operational benefits, and remind investors of the use case for SBAR. With that, let's just jump into the presentation, and let's have a little fun today. So as a reminder, SBAR is distributing 12.88% is the distribution rate. It's been the same distribution rate, 28 cents a share, since inception, which was early April 2025. The SEC yield is 3.76. That is down, and that's going to go down as interest rates normalize. We're days away from another decision here in December, whether there be another rate cut or not. But we're very happy with the distribution rate. I think over a long market cycle, we would expect that to be between 9 and 11%. It has been higher because of the elevated vol environment that Amelia and I will review a bit later. As far as the total return since inception, 12.1% is the total return with a just under 13% annualized volatility. So pretty good performance there. That if you were to annualize those numbers, you'd just be under 20%. You'll notice a little bit of a dip here in October, November-ish timeframe. Emilio, you had some thoughts on what we saw with that little bit of a drawdown here.
Yeah, so I wanted to add a few notes here. I think November was an interesting month for SBAR, right? I think it was a great example of how the product can navigate these periods of higher volatility. So if we remember in the first couple of weeks, the first 3 weeks of November, we saw this equity market correction of about 5% with the VIX going up by almost 10 points. In this scenario, SBAR was down just 2% or 2.2%. But the thing that I really want to highlight here, Jeff, is how we can actually benefit from this type of environment, right? And during this time, as volatility kept going up, we continued selling our barrier puts as normal, right, to maintain our notional targets, effectively taking advantage of that volatility move to generate higher premiums, right? But also at the same time, making sure the portfolio was well positioned for a potential rebound in the market. In particular, just to give you some reference data, Jeff, we saw levels of premia that were about 20% higher than in previous months. And of course, as the equity market bounced back in the last week of the month, SBAR was also able to recover fast, outperforming SPX in the month. So yeah, I think it was a great example of how we can navigate these episodes of higher volatility, right?
Yeah,
we've seen in the past couple of months, not only November, but also October, we saw a similar one, right?
Yeah, I think for investors to understand that volatility is actually a good thing for higher premiums from selling bearer options. So as long as that volatility doesn't approach the barrier of 30% for SBAR, I think increased vol is actually a good thing for investors. And when you have increased vol with a rising equity market, you increase the probabilities of positions
Exactly.
being called. So the product launched right after the Liberation Day in April. And so we harvested some really attractive yields. That's why we've been paying just under 13%. And then most recently, as Emilio pointed out, with government shutdown and AI concerns, that also afforded another opportunity for harvesting pretty attractive yields. So again, we're very pleased with the performance and the yields, and we'll continue on here. So the use case for SBAR, we see a lot of interest in the product. People like double-digit yields, so I've got the yields here on a monthly income basis. Typically, we go X towards the end of the month, and we pay usually the first of each month. Very attractive, 12.88%, and that's with that 30% bear option level that we'll talk more about here in a moment. Investors ask us how to position a portfolio. I would say if you're looking for income and you're comfortable with a 30% barrier, now we're using the worst of features, looking at three indices, NASDAQ, S&P, and Russell. And if you looked over the last 35 years, the worst performing of those three indices broke the barrier about 7.8% of the time over the last 35 years. So low probability event. It's not zero, but it does lead to higher yields for investors. And then as a reminder, SBAR does have some exemptions relative to counterparty risk because we're collecting the premium at the beginning of the contract. We don't have credit risk because we're not buying individual securities, and whatever duration risk we have is in the form of treasury. So we think it fits really well into a portfolio of income producing securities and ETFs. So we really like these three attributes from a use case perspective. Now, from an operational perspective, this is where we get a lot of great feedback from advisors that have kind of gone through that process of negotiating individual contracts with counterparties in the marketplace. It's a tedious task to monitor for positions that get called, and you got to renegotiate. So we're highlighting what we're hearing and feeling and seeing in the market with SBAR. Continuous liquidity, no lockups. The operational efficiencies, we have Emilio and other folks at the firm constantly watching all the positions in our barrier income suite. It's free act funds, so we don't have bank credit risk. Fully transparent. We provide weekly updates of distance to barriers on our website, and then lower fees than a traditional structured note. So the operational benefits for those investors that have used structured notes really appreciate the fact that we do this for them and the fact that it's lower cost and completely liquid. If you want to, buy it whenever and sell it in a few months when you want to, use the money for a vacation or buy a boat, you're more than welcome to do that, just like any other ETF. As far as how we're enhancing the income, now we're gaining the exposure through the bottom of the slide. We're talking about the worst of indices. So you look at three equity indices, NASDAQ, Russell, S&P. At the end of the term structure, you look at the worst performing position, and that's the one that's used to determine if you participate in the drawdown of the 30% barrier. We also add an element of callability. Callability is actually a good thing because when we sell the option, we're collecting an annualized premium. If it gets called, if all three reference indices are up from the initial value, it will get called contractually, and then we're able to keep that annualized premium and return stack and write another premium in the portfolio. I think since inception, more than almost 200% of the portfolio has been called because we've been in this really attractive market with rising equity markets. And so a lot of the positions have been called in the portfolio, and that gives us a chance to write more premiums for investors. As far as that weekly positioning report I talked about, we've been through this before. It's a little busy, so let me kind of walk you through it. The key statistics are at the bottom of the portfolio. So we have 39 unique positions that expire typically typically a Friday from the day we write the contract. And you'll notice that we've laddered these positions where no position is more than 10%. So we've smoothed that out over the portfolio. The average distance, this is as of the end of November, is 31%. That's the notional weighted average distance to the barrier. So one of those worst performing indices would have to break 31%, or the entire portfolio would have to break 31% for a significant drawdown, which is quite attractive. Just about 60% of the portfolio is in auto call status, which means the reference indices are above the initial value. And then 328 days is the weighted average days to maturity. So the x-axis shows the notional weight of each of the position. The y-axis shows distance for those three indices to break the barrier. The length of the line represents the best and worst performing of the three reference indices, NASDAQ, S&P, and Russell. The bottom of each of those dashes is what matters. It's the worst performing of those three indices. And as you can kind of see on this chart, we have a significant distance to breaking the barrier. As equity markets do their thing, the date that really matters is the last day on expiration. Markets can drop, say 10, 15%. This product would be mark to market just like any other ETF. But the key is avoiding drawing down below the barrier level, which is 30% for every position in the portfolio. Now, Emilio, we have added a little extra protection in the portfolio, so maybe you could talk a little bit about what that looks like and the percentages of the portfolio.
Yeah, of course. Let's talk about hedging, right? So first, I would like to talk about our general approach to hedging in SBAR, the way we think about it, and then we can discuss the current hedge that we actually have in the portfolio today, right? Um, First of all, as we know, SBAR is fundamentally an income generating strategy via this well-defined 30% barrier puts, right? Which means we don't want to create any unnecessary drag in the portfolio by overspending or overhedging or anything like that. However, we do believe there are opportunities in the market where we can buy very low cost hedges with very attractive potential payoffs that could really benefit the portfolio in periods of market stress. In particular, we're talking about very low or relatively low volatility regimes where we can generally get a good amount of notional coverage, about 100%, sometimes even more than 100% on things like 20 to 30% out of the money puts, vanilla puts, expiring in a couple of months, 2 months to 3 months, right? For very small spend. So that's exactly the type of hedge that we're interested in.
Mhm.
So we're looking for this classic asymmetric convexity of deep out of the money crash puts, as they call them. But again, this is something that we will do only when we can get high amounts of notional for minimal spend, covering around 2 to 3 months of protection, Jeff.
Yep.
Now, in terms of what we have right now in the portfolio, we have this hedge, which is it's an SPX 20% out of the money pool expiring in January, so 2 months out, couple of months out, worth about only 5 bips of the portfolio at the moment and covering about 70% notional
Mhm.
portfolio level, right? So that is exactly what I just described, the type of hedge that we are interested in for SBAR.
Yeah, so just to put that in context, Emilio, if equity markets become more difficult and we have a significant drawdown, that long put option would start to be monetized even before we get to the 30% barrier. So I think of it like flood insurance, like an extra layer of protection for the entire portfolio, or I guess 70% of the portfolio right now. But I think that framework is reassuring as we know equities have drawdowns typically multiple times a year. I think it's comforting to me as an investor in SBAR that that extra layer of protection is there and great to have that discussion. Now let's get a little bit deeper. So Emilio is working with these individual contracts every single day across the series of bearer options that we have at the firm. Let's kind of take a step back and kind of walk through kind of what we're seeing in the marketplace. Um, so we all know that the Fed policies are starting to normalize. Rates have been cut significantly already this year. Another one probably tomorrow. This is being recorded on the 9th of February or December. Mila, kind of give us a sense. A question we get a lot is if rates normalize, how does that affect the distribution yield for SBAR?
Right. I mean, as you already mentioned, Jeff, at the beginning, the total yield in SBAR comes from these two components, right? The income from the barrier puts that we talked about, and then the treasury yields. So this slide is just to highlight the last two rate cuts, which would naturally reduce the yield coming from that particular component, right? However, as we know, we're going to show that in the next couple of slides, how we've been generating higher yield from the put selling since inception on the high end of the range, right?
Hmm.
Around 10%, I think, in just 7 months since launching. And therefore, compensating for this reduction in rates. So, in the last couple of slides, we're going to talk about those two sources of, risk premium, right? Volatilities and correlations, and explain how we've been navigating the past few months and being able to generate this yield.
Yeah, so maybe another way to respond to that question, how does the distribution rate change with Fed policy normalizing? I guess it depends. It depends on if if equity markets remain volatile, you might actually collect more premium income, or if rates normalize and vols drop, you'd collect less, which is kind of the point of the next slide, which is looking at realized vols and maybe walk us through what you're seeing here, Emilio.
Yeah, so as I said, the next couple of slides will refer to the underlying volatilities and pairwise correlations, which are the two main sources of risk premia in our worst of baskets, right? Just to remember, Jeff, the general relationship, the general dynamic is higher vols, higher premia, but
Hmm.
also lower correlations, lower pairwise correlations, also higher premia for
Yep.
the basket, right? I like to think about it in terms of uncertainty, higher volatilities, higher uncertainty, therefore we get paid more. But lower correlations also means higher uncertainty, and therefore the premia is also higher for the basket, right? So what we have right now here on this slide is the time series of volatilities of the three different underliers in our baskets, S&P, NASDAQ, and Russell, for a 1 year maturity and 20% out of the money strikes, which is a good proxy for the volatility that we sell. We can see since launching SBAR in April this year, we can distinguish these three regimes, right? A very high vol environment at the beginning after that equity drawdown in April, and that whole tariff tantrum situation, which was, as you said before, great for capturing high premiums after launching. Then that followed, a recovery period where equities rallied for a few months and vols collapsed. But then again, that was great for the callability feature that you were talking about before, right? Since we were
Yep.
able to collect most of the higher premiums from the previous months. And then a last regime in the last couple of months, we've been seeing episodes of slightly higher vols followed by quick market recoveries that we talked about before, right? We can also benefit from these periods greatly, right? Overall, Jeff, it seems like 1 year vols have been trending up since the summer, possibly driven by the uncertainty around the government shutdown and AI stocks. Again, scenarios where we can generate higher premiums for the portfolio. I think you had some data
Yeah.
supporting,
Yeah.
right, between September and November, how the premiums have been going
Yeah,
up.
we sold the very option September 14th at 3.08%. So that would be the annualized premium for selling the volatility over the next year. So
Mhm,
3.08, and the one we sold right before Thanksgiving on November 19th, that was 4.8%. So
mhm,
308 to 4.8 in this period of on the right-hand side of the chart, as vols are increasing, that premium is more attractive for investors that are willing to underwrite that risk and the uncertainty of government shutdown. So I think it's really a cool illustration as vols increase, that premium becomes attractive. But more importantly, I think on the next slide, Emilio, we really go through what you were
mhm,
talking about earlier is just the correlations amongst the three underlyings. When things become less correlated, increase the
mhm,
probability of something break the barrier, creates more attractive yields
mhm.
for option
That's
premium.
right. Yeah, so what we have here is the time series of rolling 3 month pairwise correlations between the different underliers, which is basically a measure of how closely these names move relative to one another. We can see the same dynamic that we just talked about for volatilities, right? But now from the perspective of correlations. So generally speaking, in periods of market stress and higher volatilities, these three major equity indices will tend to correlate more with each other, right? And the opposite is true for periods where the market is calm and moving higher. Pairwise correlations become much lower, which will help maintain a good level of premium when the volatility risk source is small, right? So it's interesting to see these two forces, vols and correlations, and how they complement each other in the way they provide premium to the worst of barriers, right?
Yeah.
Um,
Yeah, good explanation, Emilio. Anything else, Emilio? You're working with the counterparties and the brokers every day. Any unusual things that you're seeing in the marketplace? Or are we just in a holiday low of get through the end of
yeah,
the year and
I
see what happens next year?
I think that's right. I think markets are functioning as normal. That's what we see from the premiums, the quotes that we get from the banks and so on. So yeah, maybe it's a calmer market into the end of the year. And yeah, looking forward to the beginning of the next year. Very excited about this product.
Yeah. Well, Emilio, thank you for joining us today. Have a wonderful holiday. And as I mentioned before, this is a monthly series for myself and Emilio, and we might bring a guest from time to
Mhm.
time to get more insights into our barrier options, specifically S-bar. But just want to thank the audience for joining us and have a wonderful holiday season.